WeeSpeak, your interactive online platform for quick English learning.
Main asset classes for retail investors.
Now, there are many asset classes out there. If we start with the main one, which is the foreign exchange or forex market, is the financial market where currencies are traded or exchanged for one another. It's the biggest market in the world, with an average volume exceeding $5 trillion per day. It usually operates 24 hours a day from Monday to Friday. And it's an OTC, it's an over-the-counter market, right? And it's used by individuals, financial institutions, businesses, and governments, etc. Now, foreign exchange transactions occur because, of international trade, tourism, borrowing or lending, and speculation, right? When we say tourism, for instance, if I'm in France, usually the currency that I'll tend to have on me is euros. So if I want to go to euros, for instance, I'll definitely trade my euros against some dollars. So tourism can cause transaction in the foreign exchange market, and borrowing money as well, and trading, and therefore speculation as well, because I can buy dollars thinking that the value of the dollar will, let's say, go up tomorrow. So I'm speculating, and if it goes up, I can sell it, right? So that's one of the reasons why it can occur, let's say, foreign exchange transactions. Now, most of the currencies today are freely floating, right? And their price is determined based on the law of supply and demand, really. So the more it's demanded, the higher the value, and the less it's demanded, obviously the lower the value. Now, another one is the equity market or share market, which is simply the place where shares or stocks are traded, right? Shares of companies. So shares are a financial asset that provides evidence of ownership in a company, and hence a share in its profit, right? So ultimately that's what it means. Now, shares of a publicly listed company like Apple, for instance, or IBM or Google, are traded in a stock exchange like the New York Stock Exchange, for instance. And if the company is profitable at the moment, right, and expected to make more profit in the future, the price of the share will definitely rise, because at that point the demand will definitely skyrocket. So fundamentally it's a company that is believed to let's say do good in the future, more people will actually rush to buy the shares, and therefore the demand will be skyrocketing, and as such the value as well will increase. Now, if a company, for instance, is not profitable at the moment and is not expected to make future profits, its share price will drop, right? Because if let's say I'm holding an Amazon share, and there is an assumption that Amazon is not going to be doing great tomorrow, I will definitely want to buy it. I'll definitely want to sell the share, which is hedging. So I'm protecting myself against the loss, right? And a lot of people will actually follow that logic, which is gonna, drop the price down. Now, in today's context with technological advancement, there is a lot of, not only ETF, let's say, even retail investors that trade with rule-based strategy. So they can play stop losses, for instance, which means that I will tell the computer that if the value of the stock price goes, let's say, reaches a certain amount, let's say, for instance, I have a stock price that is $1,000, I can tell the computer, well, if it reaches $800, you automatically sell it, right? And that is hedging. Now, as it's rule-based and it's automated, if a lot of people actually parameterize those rules in their brokerage accounts, that activate triggers when that can cause a huge sell-off in the market, and hence it stretches out the volatility of asset classes even more. right? So that's something that is a function of technological and financial innovation. Now, we can have the commodity market as well, which is the place where raw materials, instead of manufactured materials or goods, are traded, right? So it's really raw materials, and they're usually categorized into three sort of groups. So one is agricultural commodities, such as in there you have grains, certain food, fiber, like corn, soybeans, cotton, but also livestock, and also meat like cattle, for instance. You have the energy category, where you can have crude oil, Brent oil, ethanol, natural gas, and propane, for instance. Now you have the metal commodities, where you have industrial metals such as copper, lead, zinc, iron, etc. And of course you have precious metals such as gold and silver. Now another market is the bond market, or known as fixed income market, which is a place where investors and traders trade debt and securities, right? So it's the market where borrowers have a shortage of cash, and they meet investors, or in essence lenders, that have a surplus of cash, right? And the main issuers usually of bonds are governments, semi-governmental institutions such as municipalities, and corporates like IBM, for instance. Now, debt securities can be as simple as a bank loan, really, or government bond, or corporate bond. Now, when you buy a bond, okay, you're lending the issuer money. So the issuer of the bond, you're actually lending, that institution money, and they promise to pay you back in full with interest in the future. Now, that's why it's called fixed income, because the income is fixed. It's a fixed interest rate. Conversely, shares, for instance, or equity is different, because the more the share increase in value, the more you receiving in terms of profit or income. Now, just a practical example for the bonds. A city can issue a bond to lend money to build a bridge, for instance. Now, another interesting market is the derivative market. Now, as a definition, we can say that I'm really struggling with this word. So, the derivative market, or let's say a derivative, is an instrument whose value depends on, or is derived from the value of some other instrument called the underlying asset, right? So, for example, oil derivatives derive their value from the value of oil in the oil market. And derivatives are usually divided actually into two categories based on the asset they derive their value from. So we have the commodity derivatives that are based on commodities. For instance, energy contracts derive their value from commodities like oil and gas. And we have financial derivatives that are based on financial instruments such as stocks and index contracts, such as stocks and index. And stocks and index contracts derive their value from the stock and the index market. Now, there are several types of derivatives in the market, and the most popular ones are the futures, the options, and the CFDs, which is CFDs. CFD means contract for difference. Now, a future, for instance, is a standardized contract to buy or sell an asset at a predetermined price at a specific date in the future. So I can have a contract with, let's say a producer of grain, for instance, and I can tell them, because I think that the value of grain is gonna be expensive tomorrow, and I happen to be in an industry where grain is my raw material. So I can have a contract where I can tell the producer of grain that tomorrow I will buy grain at this price at $1,000, for instance, because I fear that tomorrow is going to be more expensive, so I'm speculating. And conversely, the producer of grain maybe has a fear that goes in the other way. So he thinks actually that the price of grain will probably go down. Okay, so he fears that maybe tomorrow the price of grain is going to be 8,000. So he'll be more than happy to take my proposition of $1,000 for the grain that I'm going to buy, and that's the future, as a contract. That's the future in terms of agreeing to buy at the predetermined price at the specific date in the future. Now, the other derivative that I was talking about. So we said futures, options, and CFDs. Now, an option is a contract that gives the holder the right to buy. It's the buy is called a call option, or sell, which is a put option. So buy is call option, sell is put option. So it's a contract that gives the holder the right to buy or sell a security at the specified price. So it's got the option. Now, the contract for difference, CFD, is a derivative contract used as a speculative tool against changes in value in an underlying asset. Now, some of the benefits of derivatives is that some are exempted of tax, and they can be used. They can be subject to margin trading, right? But margin trading, however, is in all case, it can increase both the profit potential but also the risk, right? So it must be used very wisely. In essence, what it means is, if I trade, for instance, a certain future based, which whose underlying value maybe is gold as commodity, and the thing is that the brokerage account or the broker can actually lend me money, right? So I'm actually trading on debt. So that's the margin account. So maybe my capital is $100. Now what it means is I can the broker platform can actually propose me to actually borrow maybe 10 times my capital. So if I have $100, maybe I can borrow $1,000. So that gives me a capital of $1,100 that to invest into that future. Now that means if there is a return of 5%, so instead of gaining $5, related to my initial capital of $100, I will actually make $50, right? Because I use the margin, and then I'll actually just repay the money to the broker, and then along with some interest rates, right? But conversely, if it goes the other way, it can result in huge losses, because the money that I put to get that margin is seen as a collateral to my debt. So if it goes the other way, I can actually lose everything, right? So it's a way that can be used to generate a lot of profit, but at the same time is very, very risky. So these are really the main asset classes that retail investors can consider. Now, obviously, we've got the emergence. Can we even talk about emergence? It's quite popular now, of cryptocurrencies, for instance, like Bitcoin, Ethereum, Dogecoin, etc. But really, these are the main asset classes that a retail investor should consider when trading the financial market.
WeeSpeak, your interactive online platform for quick English learning.